When investors think about global diversification, Europe is usually the second stop after the US. But many portfolios either overcomplicate that exposure or ignore it entirely. Today, we are breaking down a simple, broad ETF that does exactly what it claims to do. The Vanguard FTSE Europe ETF, ticker VGK. This is the ETF Investor, and this fund is all about clean vanilla exposure to developed European equities. VGK is a passively managed ETF designed to provide comprehensive exposure to the developed European stock market. It holds stocks across all market capitalizations, including large, mid, and small companies, and spans multiple sectors and countries. There's no active management, no tactical tilts, and no attempt to time markets. VGK's job is simple: represent developed Europe as a whole. The fund tracks an index that's part of the FTSE Global Equity Index series, which covers roughly 98% of the global investable market. VGK's slice of that index focuses specifically on developed European countries, including major markets like the United Kingdom, France, Germany, Switzerland, and others. Europe here is defined using FTSE's classification standards, which are reviewed and maintained over time. What matters for investors is that this index is designed to be investable. Securities are screened for liquidity, transparency, and availability, which helps ensure the fund can actually track the market without excessive trading friction. Constituents are reviewed semi-annually in March and September, keeping the index aligned with changes in the European equity landscape without constant turnover. From a portfolio construction standpoint, VGK gives you broad sector exposure. Financials, industrials, consumer goods, healthcare, energy, and materials are all represented. This is not a tech-heavy ETF like many U.S. equity funds. European markets tend to be more value-oriented, more dividend-focused, and more cyclical in nature. That difference is exactly why VGK can play a role in diversification. Now, let's talk about how VGK actually behaves. European equities often move differently than U.S. stocks due to currency effects, economic structure, monetary policy, and geopolitical dynamics. Interest rates, energy prices, and regional economic growth can all influence returns in ways that don't perfectly line up with U.S. markets. That imperfect correlation is what makes international exposure useful, even when performance lags at times. VGK is not designed to outperform the U.S. market. It's designed to complement it. In some periods, European stocks will lag. In others, especially when valuations matter or when the dollar weakens, Europe can outperform. VGK gives you exposure to those cycles without having to pick countries or sectors individually. One important detail is currency exposure. VGK does not hedge currency risk. That means returns for U.S. investors are affected by movements between the euro, the British pound, and other European currencies versus the U.S. dollar. A weaker dollar can boost returns, while a stronger dollar can weigh on them. That's not a bug. It's part of owning international assets. Another thing investors should understand is that VGK includes companies of all sizes, but large-cap stocks dominate the index because it's market cap weighted. You're getting some small and mid-cap exposure, but this is still primarily a large-cap developed Europe ETF. It's meant to be a core holding, not a niche bet. So who is VGK best for? VGK makes sense for investors who want simple, low-cost exposure to developed European equities as part of a globally diversified portfolio. It works well as a complement to U.S. equity ETFs and can help reduce home country bias over the long term. It's also useful for investors who want international exposure without picking individual countries or actively managed funds. Who is it not for? If you're looking for aggressive growth, Europe may feel slower compared to U.S. tech-driven markets. If you want emerging market exposure, this isn't it. And if you're trying to tactically trade short-term European market moves, VGK's broad nature may feel too blunt. The bottom line is this: VGK does exactly what it promises. It delivers broad, diversified exposure to developed European equities across countries, sectors, and market caps using a transparent, rules-based index. It's not flashy, but it's effective as a long-term building block for global diversification. If this breakdown helped, subscribe to the ETF Investor, and let me know in the comments how you think about international exposure in your portfolio, especially when US markets dominate the headlines.